Let's look at the futures right now, continuing yesterday's bounce back from Friday's losses. Joining us now, Amy Wu Silverman, head of derivative strategy at RBC Capital Markets, which is a nice way of saying that. I mean, you focus on technicals, but you use derivatives to figure out some technical indicators. We don't do a lot of fundamentals. I'm not going to ask you about tariffs, I don't think. But seasonal is certainly always on your mind. August is high volatility usually, and not a great month for the bulls usually.
It's not. And, the interesting thing about this year, Joe, is we have kind of followed the seasonal playbook. So we got this great July, low volatility, good stock returns. And then August, it kind of flips the script, right? August and September, you typically get a VIX that rises up 18%. It's not great for the market. There are these volatility potholes you got to watch out for. Folks go on vacation, a little bit of liquidity vacuum. And I think, it's a simple thing to state, but it really there's a reason it's called seasonality. And so I think there's a little bit of cautiousness seeping into our markets that we see, partly because of seasonality, partly because of everything else that's going on, but you are seeing indications of it.
People ask you a lot about how frothy the market is. You don't think we're at peak froth at this point?
I actually don't. And I think that surprises people when they ask, because they see these kind of meme frenzies going on. They see certain names just take off. But what I'll tell you is we now have like two other big pockets of history post-COVID. So May 2021 and then kind of back in 2020, where that meme craze really took off. And if you actually look at the absolute number of the stocks this is happening to, it's actually far less. And then the second thing that I think is really important is there hasn't been this viralness to it, meaning it's been relatively contained. You haven't seen the benchmarks blow up because of the meme craze. And then
that's an interesting point.
Yeah,
everybody comes in here and talks about how this is a sign that things are so overly frothy. I hadn't put it in the context of where it was.
It's frothy, but very contained. And I'll give you a good example. So NVIDIA is kind of like the last big Mag 7 that has yet to report earnings. Back in May 2021, you saw huge call exuberance, so massive demand for call buying in NVIDIA. You actually are seeing the opposite right now. So ahead of August 27th, you're actually seeing pretty bearish sentiment. So that you would argue, not necessarily a meme craze name, but a name that has so much concentration, it moves the index along with it. And we're not seeing that spread to names like that I would say carry much more weight than a Dunkin' Donuts or a Kohl's from a benchmark perspective.
As we go between fear and greed, and there's you talk about the benchmark spread, which is, you can, I love the word FOMO. My kids use it all the time. But the benchmark FOMO is not, we haven't seen it yet, where the benchmark moves so much that people think there's a risk to not being in, and they come piling in at the end of a move.
People can say, look, this is just like a positioning thing that happens in the end. I kind of disagree. I think it's become more and more important if you're an asset allocator, if you're sitting there and you're a portfolio manager and you see your benchmark, which is just the S&P 500 for most people, right? And it is ripping because of one name that's ripping. You psychologically feel like, wow, I'm going to end up dragging at year end because I wasn't long enough NVIDIA or enough Meta. I think that's why you get these pile-ons from this concentration growing and growing.
It's weird that who's the first person to eat a lobster? Who's looked at that and said, you know what?
Looks delicious.
Who would eat that?
They used to feed it to prisoners in Massachusetts.
Yeah?
Yeah, it was like the rats.
The reason I'm talking about this is you don't think that the lobster cooking, it's a slowly boiling, suddenly it's done. That's not, you want to switch to a duck. You think this market is like nothing happening on the surface. It's just moving, but furious paddling underneath.
That's exactly right. I think we're back to a paddling duck if we're going to choose an animal to represent this market, because we've had maybe a few bumps, but stock market's still at all-time highs, but underneath there's just these massive rotations. So
what?
So the biggest one is the rotation between factors, so momentum versus value. So essentially when investors say, I'm either going to be in the names where winners are winning, so kind of like the more technical definition of what momentum is as a factor, versus value. So when do you go into equal weighted S&P? When do you go into Russell 2000? When do you go into small caps? You've seen fits and start to that, like multi-standard deviation, 4 or 5 standard deviation moves in that. And you don't see it on the surface, one, because of the benchmark FOMO kind of masking it. And two, because there's like this lack of concentration risk the smaller you go down in market cap. Just by definition, the smaller the market cap, the less you feel like you ought to participate from a drag perspective.